Baby boomers hold half of this country's wealth, almost $80 trillion. And, to put it bluntly, they're dying.
That means that over the next few decades, an unimaginable amount of money is going to change hands. Economists are calling it the greatest wealth transfer in human history, and the main beneficiaries seem to be millennials.
That's right. After struggling through multiple recessions, skyrocketing home prices, healthcare, student loans, and a freaking pandemic, millennials are finally catching a break. In fact, some economists say it will soon make us the wealthiest generation to have ever lived. Woohoo!
I'd rather not high-five the death of my parents. But beyond that, there are a few reasons why millennials shouldn't start celebrating just yet. In fact, most of us probably won't be inheriting anything at all.
Baby boomers were born at a pretty good time economically. Since the 1960s, when they would have begun entering adulthood, median home prices have risen by almost 3,000%, and the stock market by 6,000%. That's contributed to their cohort enjoying an average net worth today of almost $1.8 million.
However, that average is heavily skewed by a small handful of super rich boomers. The median net worth, which tends to be more representative of most Americans, is closer to $200,000. Boomers also still carry debt, with a median burden of almost $29,000. That's even more than the typical millennial owes.
This means that the so-called great wealth transfer is pretty lopsided. One analysis estimates that over 40% of the tens of trillions of dollars that will be inherited over the next 20 years will go to just 1.5% of millennials. And because inheritances under $26 million per couple aren't taxed by the federal government, most of that will be tax-free. Meanwhile, the bottom 50% of households, which holds a disproportionate share of Black and Latino families, will account for only 8% of inherited dollars. This has some economists worrying that this shift will only widen America's already huge socioeconomic gap.
But what about those in the middle? Most boomers might not have $1 million in the bank, but a lot of them are still living in paid-off houses. And the average boomer has about $200,000 in a 401k, which, unlike a pension, can be handed down to their kids. With home prices at record highs, many millennials might be counting on this windfall to finally get into the real estate market themselves.
Unfortunately, surveys show that they might be overestimating how much they're likely to inherit. A majority of millennials reported that they expect to receive about $350,000 from their parents' estate. The majority of parents, however, said they plan to leave less than $250,000. Even that may be too optimistic, because there's another interested party salivating over that $80 trillion of boomer wealth, the healthcare industry.
We all know that medical costs have been soaring over the last couple decades. In addition, the older you are, the higher medical prices tend to be, and boomers are living longer and longer lives. Thanks to falling birth rates, Americans over 65 will soon outnumber those under 18 for the first time in history. Those boomers are retiring in droves from a number of fields, including healthcare, and are not being replaced by younger workers at a fast enough rate. If proposed policies limiting immigration become law, that could put further strain on the labor pool. And as anyone with a passing knowledge of economics knows, growing demand plus shrinking supply equals higher prices.
What about Medicare, you ask? The baby boomers have been paying into this government insurance program their whole lives, with the expectation that it will cover healthcare costs in their old age. That's mostly true. Although, like most insurance programs, enrollees are asked to pay premiums, deductibles, and copays, all of which are increasing. A 2022 report estimated that the average couple who retires at 65 can expect to pay around $315,000 on medical expenses over the last years of their lives.
And if they end up in a nursing home, that number can be significantly higher. Medicare does not cover residency in long-term care facilities, and these facilities are eye-wateringly expensive. With a median cost of over $9,000 a month, long-term care could easily deplete the average boomer's net worth in just a few short years.
Boomers are notorious for not being transparent with their kids about their financial situations.
If you have a parent over 65, you might not know how prepared or unprepared they are for these rising retirement costs.
But perhaps it will give you a better idea if we
Run the numbers. Unlike his older sister, Leo didn't manage to buy a house before the market exploded. Although he wishes his parents long and healthy lives, he's come to believe that his only hope at ever being a homeowner now lies in a potential inheritance.
His parents, Michael and Suzanne, retired in their late 60s with about $200,000 in savings and a paid-off house worth about $400,000, putting them well above the boomer median in terms of retirement. What's more, Michael's pension from his years as a teacher covers $2,000 a month of daily living expenses, with the rest taken care of by Social Security benefits.
Unfortunately, a few years into retirement, Michael is diagnosed with chronic kidney disease, pushing their yearly healthcare spending to about $50,000. After several years, their savings is almost depleted, and Suzanne's arthritis has worsened to the point that she can no longer act as Michael's caregiver. The family now faces some tough choices.
They could hire a live-in caregiver for around $4,000 a month, plus room and board. But it's looking increasingly likely that they'll have to sell the house to pay for further medical costs. As difficult as it is to be apart, they decide that Suzanne will move in with her daughter's family and Michael will live at a nearby nursing home for $8,000 a month.
By the time Michael passes away 18 months later, their original net worth of $600,000 is now around $200,000. With Suzanne's yearly medical expenses of $24,000, the average for her age bracket, that should keep her solvent for several more years unless she also requires long-term care.
As we mentioned in a previous episode, dying-related costs like burials and estate attorneys can reach into the tens of thousands of dollars. So it's starting to look like by the time everything is over and done, whatever Leo ends up splitting with his sister probably won't equal a down payment on a house.
Well, that was the most depressing Run the Numbers we've ever done.
True, but there's nothing to be gained by sticking your head in the sand, especially with the media attention around the great wealth transfer. A lot of millennials might be foregoing savings or investments under the illusion that a big windfall is in their future.
The most important thing you can do now is to start an open dialogue with your parents about their financial situation, including what you and your siblings are willing or not willing to do for them. That could mean setting aside a room in your home or helping them arrange long-term care insurance.
Everyone likes the idea of a bag of money being dropped in their laps, and every parent hopes to leave something to their kids that will make life easier.
But thanks to a combination of policy, demographics, and increasing lifespans, that's getting less and less plausible for most Americans.
Unless your family is already in the top 5%, prepare as if you'll be on your own.
And that's our 2 cents.
Thanks to our patrons for keeping 2 Cents financially healthy. Click the link in the description to become a 2 Cents patron.